Sea Limited, a juggernaut in Southeast Asia that has a gaming division, an e-commerce platform, and a payment solution, is up 12% after the company reported earnings this morning. So does that mean that it has turned the corner? Sea Limited is actually a stock that I owned for a number of years and I sold recently. It's looking like I might be wrong about that, but let's go spend the next 10 minutes to figure out what we need to see to know that this company's moat is actually wider than I thought, and financially it's turning a corner. When we investigate this, this is going to be the company's fourth quarter, and after today's pop, it's about a $41 billion company. Now on the top line, revenue grew 7%. That's a far cry from the triple-digit growth we used to see, but it came in well ahead of Wall Street's estimates. Management was guiding for about $491 million in bookings for its gaming unit, and it beat that handily as well. Now, the real surprise comes on the bottom line here. Analysts were expecting a loss of 79 cents per share, but Sea Limited reported a gain of 76% share on a GAAP basis. That is an enormous beat, and we need to figure out how that happened. Well, let's look at margins. Gross margins expanded rapidly, but look at the operating and net margins, which both expanded by more than 2,000 to 3,000 basis points. How did it do that? Well, first let's look. Free cash flow went from a loss of over $1 billion to a gain, slight gain. Same thing with net income, which gained about $1 billion from a loss to a gain. And the balance sheet remains in pretty healthy shape with $6.9 billion in cash, $3.3 billion in debt. So how did they do that? Well, if revenue is only up 7%, but the company swung to a huge gain, it had to be because they cut costs. And this is the main reason. They cut their sales and marketing expenses by 61% year over year, and that is how the company beat expectations so handily and why the stock is popping. It's also worth noticing this raise in the provision for credit losses on an absolute basis. That's small. It's something that we've seen with Mercado Libre lately with their Mercado Pago unit as well, and we'll come back to that in a minute. But let's go through each division. First, Garena, digital entertainment. Quarterly active users was down 15%, much more if you look at it year over year. And then I'm going to call shenanigans on management. They said, our quarterly paying user ratio was only down 0.1%. But guess what? That's a chart crime. It's also very dishonest. A better way of doing this, if we look at it year over year, is to figure out how many paying users were there actually. That's what the company used to put out. You just multiply your active users by your paying user ratio, and you see that there were 77.2 million people that were playing games, primarily Free Fire, in the year ago quarter. That went down all the way to 43.7 million. That's a drop of 43% year over year. Now, if you want to do quarter over quarter, which is what management decided to highlight because the numbers don't look as bad, you still get a 15% drop in paying users on a quarter over quarter basis. So make no mistake about it. Garena did better than expected, and it is still making money, but it is bleeding cash from a perspective of where it used to be. Let's go, and you can see that when you look at the bookings, which were down 18% quarter over quarter, been about cut in half from the year ago period. That's okay, though, and the stock is still popping because the other two divisions did so well. Look at this. The e-commerce Shopee platform saw revenue grow 44%, 54% growth in core marketplace revenue. And add that together, and it went from a huge adjusted EBITDA loss to a gain. Well, 54% revenue growth must be because a lot more stuff was sold on the marketplace, right? Wrong. Gross orders were actually down 12%, and gross merchandise volume, or the value of everything sold on the platform, was relatively flat year over year. Now, let's talk about what's going on here. If the amount of stuff that's sold on the platform stayed the same, but they collected 44% more revenue, that means they're charging their merchants much higher fees. Is this sustainable? If it is, then I was wrong about the company's network effects, the size of the moat that surrounds it. If merchants are willing to pay that because they can't get the exposure that they get from Shopee anywhere else, then that moat is much wider than I thought. But one quarter does not make a trend. And we know that some of the fees that merchants have to pay went up by about 100% in mid-January. So it will be very telling to see what happens to gross merchandise volume over the coming quarters on a year-over-year basis. That is one thing we have to keep our eye on. If we move on to digital financial services, the payment solution, revenue is up 92% year over year. They said that loans past due by more than 90 days fell from just less than 4% to just less than 2%. Not bad. However, that was because they shortened the window for the write-off period. And if they didn't, it actually would have gone from less than 4% to, they say, about 5%. They would have said less than 5% if it was less than, so we can assume that means more than 5%. That is not alarming on an absolute basis, but it is not a trend that we like to see, and it's definitely something, because that happened quarter after quarter, that we have to keep our eyes on. Now, overall, as we said, the Garena gaming unit is bleeding cash, not on an absolute basis, but from where it was before. It's still making money. That would be a cause for concern. However, it's not right now because the e-commerce division is all of a sudden sustainable, and so is digital financial services. Can those businesses succeed with huge pullback in sales and marketing and charging merchants more on the platform? That is the $1 billion question that we need to keep our eyes on. It's also worth noting that shares outstanding were diluted on a diluted basis, increased by 10.5%. So that's something to keep your eye on as well. Overall, management didn't provide guidance, and I didn't get a chance to listen to the call this morning, but Wall Street's calling for 4% year-over-year growth. I expect that to be revised upwards. They're expecting the company to lose 33 cents per share in the first quarter. I expect that to be revised upwards as well. For the full year, Wall Street is expecting $13.7 billion in sales and a loss of $1.83 per share. I expect both of those to be revised upwards as well. So what should we watch moving forward? Now, this is the key. Can Shopee gross merchandise volume at least stay stable or start to grow with very little sales and marketing and charging those merchants more? That is the key question. So keep an eye on 1 and 2, Shopee gross merchandise volume and Shopee revenue. That is key. Number 3, keep an eye on those credit losses from C-Money. And number 4, free cash flow. Overall, I think the moat is stable. And I think it's worth at least being cautiously optimistic. Look, it all comes down to whether or not that network effect surrounding Shopee is real or not. And we will see that in the dynamics with gross merchandise volume and revenue over probably the coming 4 quarters. But what about value? And let me just say, I can't give a score on this because it is now impossible for me to evaluate whether or not this is a wide moat business or not. We will see. We just knew that they cut costs and they didn't lose business overnight. But what is that going to do to the long-term trajectory? We will see. Next, let's turn to valuation. And I want to just mention right now that today at noon Eastern, or you see 11 o'clock where I am Central Time Zone, Brian Feroldi and I are going to have an absolutely 100% free webinar on the valuation mindset spectrum, where we talk about the difference between investors like Ben Graham and Warren Buffett, value focused, to David Gardner and Mark Andreessen, who are more likely to be invested in a company like C Limited. That is 100% free. Click the link in the show notes below to attend and get a copy of the recording. Now, to figure out how to value C Limited, we need to figure out where on its life cycle it is. And I would say that it has moved into that self-funding area because it is now sustainable. It's not bleeding tons of cash anymore. Because of that, we at least know that operating income, net income are positive, at least on this quarter's basis, but they're certainly not optimized. And because of that, we really only have the price to sales and the price to gross profit ratio to look at. Price to sales ratio, it's trading for about 3 times sales. That's actually quite low compared to where the company has been historically, and it's not totally unreasonable on an absolute basis. Price to gross profit, it's much the same thing. If you add in today's bump, it's about $5.2 billion in gross profit. Company is trading for about 8 times gross profit. that means we don't really have that many ways to value this company in general. That's one of the reasons why we think attending today's seminar will be so helpful, because we'll talk about 6 different ways that you can value a company, including things like discounted cash flow, reverse discounted cash flow, and total addressable market. So when it comes to C Limited, this is a company that I could be wrong about. They were able to slash costs and not lose a ton of business almost overnight to a degree that I have rarely seen, but it's one that I'm going to keep my eye on before I buy back in. If you thought this was helpful, give us the thumbs up, leave a comment in the comment section below, and don't forget to click on that link to register for our webinar. We'll be back to this one in 90 days. Brian